So welcome to Elisha FX. Once again, this is Kelvin Ziwa, and in today's episode, we'll be talking about something very, very basic, very common in the forex market, and that is the fair gap value. So to begin with, what is a fair gap value? So a fair gap value is simply an imbalance. If I was to show this in a demonstration, it would be like in this form. So like I said, it's just an imbalance. So let's say you have a trend that is moving to the downside, like it is indicated with the 3 candles there. So the space that is created, you see those wicks that are there for each candles, right? On the upper wick and the lower wick. So the space that is left between the first and the third candle, so from there, this is the top candle here, and then the down candle, like the third candle here, the upper wick ends right there. So the space in between those two candles, the first candles and the third candle, that is the fair value gap. So it is simply a gap in the market that is usually respected. By respected, we mean the market will always try to like go back to these areas and then retest before the market can really continue like going to its trend. So like I said, we'll be expecting a retracement until to that level before the market continues with a down trend. And that can be used as an entry point as well as an exit point. So you can enter your trade there. You'll be looking to get your profit all the way down there, but that would be your stop loss up there. You see that? So yeah, so like I said, it can either be used as an entry point or an exit point in the market. So this is a simple illustration of what a fair gap value is. And so taking it to our analysis, today we have the GBP, JPY. And so looking at these structures that were formed here, as we can see, in the actual sense, in a higher time frame, this is a 1 hour time frame. So in a higher time frame, I analyze the market to be in an uptrend. So like in whatsoever analysis I was doing, whatsoever trade I was doing, I was looking for buys. So where exactly am I expecting the market to come back to retest so that I can enter as a trader? So this exactly the same way we did with the illustration there is the same way we're going to do here. So these lines here indicate the gap that has been left by the market as it moved upwards there, as you can see there. So as a trader, you have missed this bullish trend, bullish movement that is there. You won't enter a buy on the top of where the market is right now. Why? Because the market has already moved with a lot of momentum, and you are more likely to witness a retracement before the market can continue with its trend. Like I said, so we are expecting the market to come back to this level here. Why? Because that's where the fair value gap is. And so you can't enter a buy from there. What will you do? You wait, you'll be patient, you wait for the market to drop all the way to that fair value gap before you can enter your buys. So this here is our fair value gap here. Let me indicate it with so yeah, so here we have two fair value gaps, one below there and the other one is on top there. So as you can see, you can also indicate this as a fair value gap. But which fair value gap are you going to respect between the two? So that we have what you call you have a lot of indicators that can help you know exactly where you would take your buy. But in this case, in most cases, I would say the lower fair value gap is always respected on the buying trend. If you are about to buy or if you are looking for a buy, a lower time a lower fair value gap is mostly respected. And then also you can use some tools like Fibonacci in order to measure the movement, the upward movement there, and try to predict exactly where the market will do it or bounce off. And like we said, the fair value, the Fibonacci, the most respected areas are somewhere 68 or 51, somewhere there in between. So as you can see, time we played the market went a little bit higher, as you can see there, and then it came back all the way. It tested the first fair value gap, as you can see, and then there are some people who can enter buys here, and that's the reason why I said it's always advisable to enter on a lower fair value gap, because even the lower fair value gap on a bullish trend must be respected. It's not just the upper fair value gap. So once the market respects the lower fair value gap, it means it would have automatically respected the upper fair value gap as well. You get, but once it just respects the upper fair value gap, it means the market is more likely to come back again to respect the lower fair value gap. So in my case, as it is a bullish trend, hence my analysis is that the market should come back all the way to the lower fair value gap. That's why I can enter my trade. So as you can see, it went a little bit up, then it came back again. As you can see, it hit again the first fair value gap. It was another reaction. It came for the third time, it hit another reaction. But as you can see, the market was still moving on the lower side. It was moving more and more on the lower side, as you can see, until right there. So as you can see, if we were to extend this part, this lower time fair value gap, this is exactly what the market was aiming to hit, and it hasn't yet hit, but in the few next candle, as you can see there exactly, that's why I can enter my trade. Why? Because it has now been respected, and that's the bottom fair value gap, and hence that's where I can enter my buy and aiming to take my profit on the previous high, the previous highs that were formed in the market. So like let me just zoom in, put this part here. This was a major high that was in the higher time frame. So I'll be looking for the market to go all the way up there and then to hit that up on the top there. As you can see here, the market broke, retested, and so if I was to show this in terms of the buying, where I'm going to place my buy, where my stop loss is, and my take profit, this is exactly how I would place it. So the lower wick that was formed during this retest here would be my stop loss, and then the previous high in the high time frame that I've indicated there would be my take profit. So let's see how the candles would play out. So as you can see, our take profit was hit, and there was even an extension into the psychological level up there, which is the green line. So that's exactly how the fair value gaps work. So you can easily use them as entry points, like I use them in this video, or an exit point. So looking at this movement, this same movement that we have caught here, there are other gaps that have been formed again in the market, and they were already retested. So the first one here, the immediate upward movement that was there over here, as you can see, there was a gap in between the first candle and the third candle here. There was a gap that was left in between, and as you can see, the market created that gap, went a little bit higher, then came back to retest that gap before it could continue with an uptrend. as you can see there. And so if you entered the trade all the way down there, it means that these are retests, these new retests that are there in these new fair value gaps that have been formed. This is where you will be adjusting your stop loss. So the first level of adjustment for your stop loss should be the break even. So the break even is simply the point at which you enter the trade. That's why you move your stop loss at first. Once the market moves as high as it did in this example, and then once a market has retested a fair value gap like it did here, that's why like you move your stop loss to that new fair value gap that was retested up there, as you can see. So like a person who didn't enter down there in this trade would wait for the trade to retest this fair value gap that has been created. This new fair value gap that has been created can be used as an entry point. Like I said, fair value gaps are used either as an entry point or an exit point. So there are some people who might have got the trade all the way down there because they used the fair value gap that was created previously there. But if there's someone who didn't enter, there's a trader who didn't enter at this point, so they would what do they do? They would wait for the market to come and retest this new fair value gap like we have indicated here, and then immediately it was retested. As you can see, there was a huge bullish movement to the upside, and that's what you have here. And so a trader might have entered up there aiming to get their profit all the way up there. So indicating another fair value gap. There are always fair value gaps that are created in the market. Like I said, this video is just about you identifying the fair value gaps and using them adequately. So in this case, this is a fair value gap that was used, and as you can see, there was an upward movement by from the market here. And so even if you miss the second entry point there, you look for another fair value gap. Why? Because the market is still in an uptrend. Don't forget, we are relating these fair value gaps to the trend of the market. So as we have seen in a higher time frame, like I said, I've already done my analysis in a higher time frame, it is a bullish trend. And if it's a bullish trend, all you'll be looking for now is your entry points and exit points. So like I said, if you didn't enter the first, the third, the second, it means that you'll be aiming to enter for this part here, the third part, the third part here where the fair value gap was created again. And so you'll be waiting for a retest, and you'll be aiming for what? You'll be aiming for that same high that was created in the market as your exit point. As you can see, as I have indicated there, there goes the market, and voila, it has hit our target point there. As you can see, another as the market was going up, as you can see there, another gap was created. So all you have to do is just keep on identifying the areas at which the market is more likely to come and retest, and that will be your entry point. That is if you keep on missing the previous points. So there are people who may be excited because of this bullish movement. They may enter a trade on the top there, on the right top here, and what happens, the market will start retracing once they have entered the buy, and they end up losing a lot. So that's the importance of these fair value gaps, because you'll be able to identify. Like I said here, there is a fourth now. In just this same movement, there is a fourth fair value gap that has been identified. So a fourth entry was identified, meaning that gap there, immediately you miss that trade, you wait for the market to come and retest at that fourth fair value gap, and that's why you may enter your other trade. So this is how you can easily use the fair value gap. We have talked about a situation where a market has formed just one fair value gap, and the first situation here is where the market has formed two fair value gaps, as I indicated there. And in a case where it is in a bullish trend and it has formed two fair value gaps, make sure you try to wait for the market to hit the last point here, like I indicated here. The last fair value gap is more likely to be respected, and once the last fair value gap is respected, that's where you can enter your buys in a bullish trend. Like I said, it is also correct in the opposite, where the market is bearish. Once you have two fair value gaps, you respect the topper, the fair value gap that is on top. That's why you'll be aiming to make your sales. So like I said, here you see you have the first part here, the third, the second, the third, and the market went all the way up here, came back down, retested, it went again a little bit up, created another fair value gap there. As you can see, it went up here. Then another entry point, which is the fourth entry point, was there as the market was retesting the fourth fair value gap, and then it went all the way again to hit the same target. It's the same target that we have even in the first fair value gap. And so I hope it's very clear. That's what a fair value gap and how you can use it. Thank you.